The Nasdaq 100 is underperforming again this week. On Monday, it closed down by more than 2.5% amid fears of inflation. The 5 year break even rate, a key gauge of bond traders' inflation expectations, rose to the highest level since 2008. So, is it just inflation that's causing pressure on the Nasdaq? With me to discuss is Serge Berger from thesteadytrader.com, who's here to talk to us about some options trade ideas as well. Serge, great to chat to you. Let's discuss the recent underperformance that we've seen in the Nasdaq. How much of that is about the moves that we're seeing in the bond market?
Hey Victoria, I think to some extent it's related to the move in yields, um, but it's probably not the whole story. One simple way of looking at the dynamic in an asset class is by looking at it in relative terms. And so, what I did is I brought along a couple of charts, and you can see one chart here is the Nasdaq 100, and I divided it by the New York Stock Exchange Composite. Why would you do such a thing? You would do such a thing to see what the Nasdaq's performance is in relative terms versus, in the case of the New York Stock Exchange Composite, the average stock. And you can see that there's been a dramatic outperformance over many years by the Nasdaq versus the average stock, but that has of late started to break down. You can also pin this against other assets. So if you were to make the same chart where you take the Nasdaq 100 and divide it by, say, commodities, right? So it's partially an inflation story, and I think that this one particularly here, the commodities, where the Nasdaq is breaking down versus commodities, are particularly interesting, but it's not the entire story.
Yeah, now it's sort of in terms of what we've been seeing with inflation expectations and yields lately. There's been a lot of talk about the 10 year in the US, of course, but you've been noticing some interesting moves in the German market as well.
Yeah, I think I just I cut this chart here earlier today for our clients, and just to give people an idea that this move in yields is not just a U.S. phenomenon. It's you can kind of look at it across the world. We're going to just focus on U.S. and on U.S. and Europe, but this is the 10-year yield in Germany. You can see it around negative, depending on which second you look at it, negative, let's call it zero point 0.8 or so, working its way towards that zero bound, which is a place it hasn't been since about 2 years ago. So it's really a global reflation story, and I think that is something that people maybe. I still think in general people are probably underpricing or underestimating the crazy boom we're going to get from a global economic perspective.
Now, in terms of your outlook for the Nasdaq and the US tech sector, we've obviously seen this underperformance. Is this a chance to buy some of these stocks for a little bit more cheaply, or is this a trend that's likely to continue?
I think it depends on your time horizon, right? So to give you one way of looking at it, here's a simple chart of, say, Amazon, and Apple looks more or less the same. These stocks haven't done anything since roughly August 2020. I think these are great companies and they will grow, but I think the rate of change of growth has probably peaked. I mean, this may be famous last words on my part, but it feels like, the trade has gotten so crowded. They've taken up so much market capitalization. It has a lot of signs from that perspective that it may be over. Now, they could reinvent themselves and continue to grow, which I have no doubt they will, like a Microsoft did. I don't know if you have to buy these stocks right now. I personally think you can pick them up cheaper over time. But I think more importantly is that the momentum trade in these big names may have come to a pause, at least for the time being.
Now, I know that you trade the options markets quite a lot, and you've got an interesting trade on the Nasdaq. This is a bear put spread. So, could you firstly just explain the dynamics of the trade and just also a little bit about the payouts?
Yeah, sure. So I have to look at the options premiums exactly to see how much these trades cost right now. But basically, if we're looking at putting on a directionally bearish trade for the Nasdaq, as we think it's going to mean revert more to the tune of 5 to 10%, maybe 20, maybe 15% is entirely within our framework, reasonable framework expectations. There's a couple of things you can do. You could just buy a put, but I think a lot of people don't understand how risky it is just to buy a put. So we like to buy a put spread. So in this case, what we're looking to do is we're looking to buy a strike, a put at the 320 strike level, and then sell against that for protection another put at the 310 strike. So what you're doing by not only is that cheaper than buying a put because you're offsetting the cost of the put by selling one, you do have limited risk where you have even more limited risk. So I think a lot of people when they look at options just look at the potential payout, which most of the time 98% doesn't even come close to realization. So it's really more about focusing on the risk in this case. And I would use July monthly expiration options for this. We don't want to hold the trade that long. We want to hold it for maybe 3 weeks, but by using options that expire a bit further out as opposed to the immediate options like here in May or June, you give yourself a lot more room for error from not from a time perspective, but in terms of the options Greeks.
Yeah, and you've got another similar trade idea. This is on the S&P 500. Again, another bear put spread for the July month. Talk us through this trade.
Yeah, you know what I'll do quickly. I'll show you what the long-term monthly logarithmic chart. I know that's a mouthful. Looks like of the S&P 500 SPY ETF, and that looks like this. Basically, we've finally reached the upper end of a trend that's been in place for 12 years in the logarithmic monthly chart. Why would you look at a log chart? You look at a log chart because it kind of smoothens the very steep lines to a bit more manageable, easier on the eyes. I think it's overbought for the short-term time frames. Again, I would use July monthly expiration options. And let me zoom in a bit closer. I think here one could just buy a 415 strike put and sell against that the 400 and let's say the 410 strike put. And again, it's not an exact science, but as long as you capture roughly speaking that range. So again, July buy the 415 strike put, sell against that the 410 strike put. And again, the benefit of the spread is that you're focusing more on the risk as opposed to the reward. You can't make as much, but you're also not going to lose as much, and you have more defined reward to risk levels.
And just very finally, when we're looking at some of the moves that we've seen, say for the Nasdaq, after a year when we've seen a major outperformance for tech, driving the gains in terms of the US averages, when we compare that to what we're seeing in terms of the commodities markets, it must be tempting for investors to be looking further afield for returns. I mean, copper's at 10-year highs, oil back into the $60 a barrel for WTI. We're seeing gold move higher even, and silver as well, and plenty more commodities within the base metal space as well. Is that where the opportunities are for good returns right now?
I think it depends where. I think we've had an initial sort of reaction, everything higher based upon very much that reflation trait that you allude to, Victoria, and I think that not only in hindsight, but I think for a lot of people that made sense as this came to fruition. The question, of course, is what now? I personally think both oil and things like copper go higher, but we've also seen a lot of food inflation that you and I spoke off camera before. I'm not quite sure the lines are parabolic for everything commodities, because commodities is a very big, broad asset class. But I do think there's a tendency for us to see more gains. More specifically for copper, I brought along the longer term monthly chart, and you can see we've just recently broken, to your point, out to fresh all-time highs. Haven't seen these kind of levels ever, but last time we basically overshot the February 2011 highs. I think in the very short term this is getting very overbought, but if you look at this through the lens of a few months, maybe a few years, there still is a big supply and demand imbalance. If we're entering the electricity age where everything's electric, from your cars to maybe your airplanes at some point, then there's a lot more copper that needs to be needed, and there hasn't been any major copper mining findings of late. So by our estimations, maybe we're 3 to 5 years in the hole in terms of having less supply than the demand.
All right, Serge, it's been great chatting to you. Thank you so much for all your insights as always.
Thank you.
And that was Serge Berger from thesteadytrader.com. I'm Victoria Scholar. Thank you so much for watching this video on IGTV. You can find more from the team. We're on Twitter at IGCom. For more videos like these, make sure to follow us on Twitter. We're at IGCom, and you can subscribe to our YouTube channel. It's IG UK.